Hello and welcome to FAR, Financial Accounting and Reporting. Roger Phillip, right? And make sure, incidentally, if you haven't already watched the intro section, it's like 45, 50 minutes long. It talks about the exam in general, and then there's also a couple of minutes specifically about the Financial Accounting and Reporting exam, or the FAR, a long way to run. All right, starting out here, we're talking about the Conceptual Framework for Accounting, and then after that, we'll talk about IFRS, International Financial Reporting Standards. Starting out with the Conceptual Framework. The FASB established the Conceptual Framework as a way of determining and defining the objectives and concepts that underlie financial reporting. Now, when we talk about financial reporting, we're talking about these financial statements. And for those of you that are studying for the audit exam, you'll hear this again and again. Whose statements are these? Management. Management is responsible for the preparation of these things. Management is responsible for the content. Our job as an auditor, should we decide to accept it, is to obtain sufficient, appropriate audit evidence in order to corroborate the assertions and then to finally give an opinion on these financial statements taken as a whole. So what we're trying to do is we're trying to go and give an opinion. That's what an audit is. Here in Financial Accounting and Reporting, in FAR, what are we dealing with? We're talking about what are these financial statements? What are the concepts? What are the objectives that underlie these basic financial statements? Now, you'll see here it says, in looking at these financial statements, we start out with a couple of primary objectives of these financial statements. And basically what it says is we're trying to focus on what is important to the users of the statements, the users of these financial statements. So when we talk about defining things like materiality, it means how significant, how important something is for these particular users in relation to the entire financial statements. Starting out with these statements, it says there are several or 6 primary objectives of financial reporting. First of all, to provide information that is useful to the existing and potential, so the current and the future, investors, lenders, and creditors. So what we're looking at is investors, people that want to invest or buy stock in the company, lenders, people that are going to loan us money, and then all of these creditors. So all of these are people that are concerned with these specific financial statements. A second primary objective is the information talks about the economic resources and the claims against those resources. And the economic resources claims, that would be our balance sheet or our statement of financial position. We've got our changes, right? Changes in economic resources and claims to those. The changes would be like the income statement, because an income statement would be this year only, where the balance sheet is cumulative, all the years. How much cash at the beginning, how much cash at the end, that's cumulative cash, whereas your income, sales, cost of goods sold, net income, that's going to be this year only, changes. Financial performance related to accrual accounting, and accrual accounting basically says that we're using accrual versus cash, because remember, it's an accrual world. Get it, accrual. So what is accrual accounting versus cash? Cash says you give me $100, I debit cash, credit revenue. Accrual says I billed you $100 because I performed the services. You have not paid me yet, so I debit receivable, credit sales revenue. So I do have a revenue even though I haven't touched the cash. So you'll see cash versus accrual, cash versus accrual. We're going to talk down the road about a statement of cash flows. We're going to talk down the road about converting from cash to accrual or accrual to cash, because you might have a company that has their financial statements based on one method versus the other. Now, what that means, though, is what we're saying here is financial performance reflected by accrual accounting, which provides a better basis for assessing the entity's past and future performance than does cash. Because you could play with cash, right? You give me a check today, but if I'm not going to deposit it today, then it may not be a revenue based on cash. Whereas if I've earned it, whether I deposit it or not, or if I've earned it, whether you've received it or not, it's still a revenue. So that's where the numbers on the income statement are going to be a little bit more consistent under accrual accounting. We've got financial performance reflected by past cash flows. That'll deal with a statement of cash flows, which has different sections in it called operating activities, investing activities, financing activities, and we'll define all of what goes into each category. And then finally, changes in economic resources and claims that are not relating to the financial performance. So there are changes in the resources. For example, if we issue common stock, we have debit cash, credit common stock, credit additional paid in capital. So we have money coming in, but it's not from the normal course of business. It's from issuing things like stock. So when we look at this, we're talking about what are the main objectives? What do we want out of a good set of financial statements? We want this to provide useful information to creditors, investors, and lenders. We want it to talk about the economic resources, the claims to those resources, custody of the resources. We want it to talk about the balance sheet, the income statement, cash flows. We want it to be based on accrual accounting. That's what we're talking about. Those are the main things we want out of these financial statements. Now, we can meet those objectives if you're